These investors think taxes are something you deal with after you make money. But in 2026, the smartest investors in America are doing the opposite. They're designing their profits around the tax code itself, quietly using a narrow window of opportunity that most people don't even realize exists. While the average person is writing a check to the IRS every April, a small group of real estate investors are legally deferring, reducing, or in some cases eliminating massive tax bills altogether. And at the center of this strategy are two powerful tools that, when combined correctly, can completely change how wealth is built in the United States: the 1031 exchange and bonus depreciation. To understand why this matters right now, you have to look at what's changing. The tax environment is shifting. These certain advantages that investors have relied on for years are starting to phase out or tighten. That's why 2026 is being called a loophole window. It's a period where the rules still allow aggressive tax strategies, but the clock is ticking. Investors who act now can lock in benefits that may not be available in the same way just a few years from now. And the strategy starts with the 1031 exchange. One of the most powerful tools in real estate investing. A 1031 exchange, named after Section 1031 of the IRS tax code, allows you to sell an investment property and reinvest the proceeds into another like-kind property without paying capital gains taxes at the time of the sale. That means instead of losing a large percentage of your profit to taxes, you can roll that entire amount into a new investment and continue growing your portfolio. Imagine selling a rental property with a $200,000 gain and not paying taxes on that gain immediately. Instead, you use the full amount to acquire a larger, more profitable property. Over time, this creates a compounding effect that dramatically accelerates wealth building. But this is where it gets even more strategic. Smart investors aren't just deferring taxes with a 1031 exchange. They're pairing it with bonus depreciation to actively reduce their taxable income. He told him, Tadden, bonus depreciation allows you to write off a significant portion of a property's value in the early years of ownership, even though the property itself may be appreciating. Through a process called cost segregation, investors break down a property into components like appliances, fixtures, and certain structural elements, and then depreciate those components at a much faster rate. In 2026, bonus depreciation is still available, but it's no longer at the 100% level that existed in previous years. It's being gradually phased down, which is exactly why this window is so critical. Investors who act now can still capture substantial upfront deductions, potentially offsetting large amounts of income. This becomes incredibly powerful when combined with a 1031 exchange. You defer the taxes from the sale of your previous property, then immediately generate new deductions from the property you acquire. It's a 1-2 punch that can significantly reduce your tax liability while continuing to grow your asset base. Think about how this plays out in real life. An investor sells a small rental property, uses a 1031 exchange to move into a larger multifamily asset. He then applies cost segregation to unlock accelerated depreciation. The result is not just tax deferral, but potentially a paper loss that offsets other income, even while the property is producing positive cash flow. This is how many high net worth investors legally reduce their taxable income to levels that seem almost unreal on paper. Of course, none of this happens automatically. The IRS has strict rules around timelines, property qualifications, and execution. With a 1031 exchange, you have a limited window to identify and close on a replacement property. With bonus depreciation, the calculations must be precise and properly documented. This is why serious investors work closely with tax advisors CPAs, and qualified intermediaries to structure these deals correctly. The strategy is powerful, but only if it's executed with discipline and accuracy. What makes 2026 different is the sense of urgency. With ongoing discussions around tax reform, depreciation schedules, potential changes to real estate tax benefits, the current environment may not last. Investors who wait on the sidelines could miss out on one of the most advantageous periods for tax-efficient wealth building in recent years. Meanwhile, those who understand the system are positioning themselves ahead of the curve, using the tax code not as a burden but as a tool. At the end of the day, the biggest shift here is mindset. The average person earns income, pays taxes, and then invests what's left. The sophisticated investor invests in a way that shapes how much tax they owe in the first place. That's the real game being played in 2026. It's not just about how much money you make. It's about how much you keep and how efficiently you can grow it over time. And for those who understand how to combine 1031 exchanges with bonus depreciation, this window isn't just an opportunity. It's a strategic advantage that can define their financial trajectory for years to come.